Good morning, everyone. This is Susan Milazzo with the California MBA, and thank you for joining us for today's webinar. Like all of us, we are managing through the COVID-19 crisis, and we're endeavoring to provide a lot more web-based content, education, and abilities to connect and find out what's happening in the industry and how we can provide our best tools to move our companies forward during this crisis. Today, we're going to hear effective strategies to manage through the pressures of COVID-19. And we have our speakers, Jeff McCarty and Jim Glennon from Optimal Blue, that are going to walk us through their information. Before we get started, I wanted to give you an update on something that's happening in the California State Legislature. As you all know, advocacy is the core of our mission for the California MBA. And I do have one bill in particular that I would like to share with you. We were made aware of its introduction last Friday afternoon and wanted to share it with you. Legislature, by the way, has been in recess for the last several weeks due to COVID-19, and the California State Assembly returned on Monday, May 4th. What that means is that we're going to have a shorter time period in the legislature to manage any legislation that's moving. Legislative leadership has directed the members to dramatically reduce the number of bills that they are moving this year, and the vast majority of those bills will have to relate to COVID-19. That and the kind of virtual aspect of advocacy, which is all new to us, is proven to be rather challenging, and so it's highly important that we work, double down on our efforts as far as advocacy to make sure that there are no unintended consequences of legislation that passes. So just in print today, we have 2501 by Assemblymember Limon. She's also chair of our Assembly Banking Committee. It is a very problematic bill. It's an omnibus bill that covers multiple sectors of the financial services industry. But among some of the mortgage-related provisions I wanted to share with you, it essentially allows for forbearance with no real proof of COVID-19 impact for at least a year following the COVID-19 emergency. A servicer cannot take any action and cannot assess any fees or penalties during that time. Upon the conclusion of forbearance, servicers must determine the borrower's ability to repay and work to modify that loan. If servicer violates any provisions of the bill, they forfeit the right to foreclose on that property. These provisions, of course, are in addition to the CARES Act, California Homeowner Bill of Rights, and provisions with the GSEs. On the multifamily side, the language of the bill does provide a commercial servicer to be in compliance if they are in compliance with the CARES Act. So obviously, those are only a few aspects of the bill. Wanted to share it with you. Again, we have a very short window of time to work on this. This bill will be heard in Banking Committee on May 19th. And our main focus, this is our main focus from an advocacy standpoint, and we'll certainly be keeping everyone abreast of developments. You can visit our website. We will be giving updates in our weekly videos, and you're certainly welcome to email me if you have any questions on how that bill is progressing. But wanted to share all that with you. It's our highest priority right now, and we're working with some of our industry partners on as we develop our opposition to the bill. And with that, again, I would like to turn it over to our speakers today, Jim Glennon and Jeff McCarty with Optimal Blue, to talk about effective strategies to manage your P&L pressures during the COVID-19 crisis.
Hi, everybody. Thank you for joining us today. Honestly honored that you take an hour out of your day to listen to what we have to say and to discuss some things with us and maybe ask some questions here towards the end. Some of you have been with us on our Optimal Blue webinars the past couple of months, but a lot of you are new to what we have to say. So certainly, I'm not real certain of the diversity on this call at the moment, but so we're going to recap some of the major industry and economic things that have happened over the past couple of months, and then start to get into where we are today, and some updated data and some strategies that you can bring forward into the current market. So there's a ton of webinars out there, a ton of articles out there. We're really going to try to distill some of this down and give you a state of the industry right at this moment and focus on some of that updated data and strategies and just have an open and honest discussion about what's going on. So please do ask questions. I think that's important. Certainly if we breeze past anything that needs a little more explanation, please bring that up and we're happy to go over it again. With that, we will just get right into the slides. We're going to talk a little bit about global events that have led up to where we are today. We're going to look at just the interest rate market and the TBA market and how there's been a little bit of a disconnect between those two. We're going to touch on some economic and policy implications of what's been going on with the coronavirus. We're going to talk about investor price basis, which is a huge, kind of subset of the drama that's going on right now. The best efforts mandatory spread index, we're going to touch on that and how it relates to all of this. Investor win rates. That's a big thing that's changed quite a bit over the past couple of months. Talk a little bit about guideline and LLPA overlays that have resulted from some of the drama that's gone on in the past couple of months. Some mark-to-market updates, so what's been going on with gain-loss, P&L of various lenders out there in the market during this time. Talk about some competitive business intelligence that you can use to kind of benchmark yourself against your competitors during a volatile time like this when you really need to be thinking on your feet and making a lot of changes. And we'll talk about how to strategize more effectively as we keep going through this crisis. And then we'll talk a little Q&A at the end. Hopefully we'll have a little bit of time for that. So we'll burn through some of this pretty quick so we make sure we've got 15, 20 minutes at the end to talk. So status of global events, a lot has happened, but the latest is the non-farm payrolls came out Friday. 20.5 million people lost their jobs just in the month of April, which is an astronomical number compared to anything we've ever seen. I mean, even the Great Depression, there were job losses that were that bad, but it happened over a much longer period of time. For that to happen in 1 month has never been seen anywhere in the modern world. Well, that brought the unemployment rate to almost 15%. And at the same time, and very much related to those numbers, latest stats say that about 3.5 million mortgages are currently in forbearance, which represents about 6.5% of all mortgages that are out there. So related to what Susan was talking about earlier, it's a big concern, right? It has a major impact on our industry and potentially on housing values as we continue to go through this quarantine, over the next year or even two. Government-wise, multiple rounds of economic stimulus, right? I think that's helped prop things up and at least create some stability in markets and a little bit of confidence. That was a much bigger news item at the very beginning of all of this when there was really no certainty on what was going to happen with so many people losing jobs and businesses that could no longer stay open. The Fed, on the other hand, is directly influencing the markets by propping up mortgage-backed security prices. They've purchased about $623 billion. That was as of last Friday. That was since they started that operation on March 16th. And that number has dwindled significantly, which I think is a good sign that the market is, maintaining some stability on its own. The purchases are down about 85% from the highs. So at the end of March, Fed was buying, high 30s, low 40s billion a day. And they're down to between 5 and 8 a day now or less. Some states are starting to open up very recently or in the past couple of weeks. So all eyes are on that to see if if that ends up being, puts some health back into the economic situation, or if it causes, what they call a W-shaped recovery, where we have another jump in cases and end up, having to shut doors and shut businesses again. So just to, go way back to the end of February, early March, right? Just to set the stage for what's been happening and show some of the data that's been put together since then. The market was kind of in a healthy rally as the global economy was starting to slow down. The virus was still primarily in Asia and a little bit of Europe, and the market was rallying, right? Volume was up, margins were starting to go up, rates were coming down, and then in very early March, the market started getting very volatile and very worried about what was happening with the virus. So the stock market crashed. The money was basically coming out of the system. Commodities crashed, bonds even crashed, to where the Fed had to step in right there in that first arrow and start buying bonds. And they had basically what amounted to $200 billion to spend on mortgage-backed securities, and they spent it very quickly and basically just injected a little more instability into the market. If anything, you can see the ups and downs during that 1 week period between about the 12th and the 17th. The market was churning several points in a day, and that continued until the Fed came in and basically doubled down. Right? They said, we now have a blank check. We're going to purchase as many securities as we feel we need to stabilize the market. And the market went on like a 5-point run at that point, to the point where, as many of you know, the Fed almost broke lenders, essentially, right? The margin calls were daily. Mark-to-markets streamed to highs that most lenders had never seen. And the MBA quickly got word up to the Fed that, they were kind of breaking the middle market, breaking the supply chain a little bit, by that kind of incessant rally that they had caused. And right about the 30th of March, the market hit a peak, started to sell off a little bit, and we've been very flat since then, kind of eerily, but very comfortably flat since the 31st of March till today, as you can see with that line on the right side of the graph there. So during that time, as I said, this is another good illustration we've used to talk to a lot of customers, a lot of banks, even some regulators and agencies, right? Just to really get a grasp on what happened. So the orange line is the Fannie 2.5. So was the previous graph, the UMBS 2.5. You can see the volatility in late March and then the sustained rally. And during that time, basically there was a lot of cash being pent up in margin calls. And that's those blue bars at the bottom. Blue bars at the bottom represent negative mark to market for lenders. It's just an average of what lenders were seeing in their mark to market in terms of exposure to broker dealers. So it kind of paints that picture of how did those margin calls get there? Why was it so intense, right? Even if you look back at February when the market was in quote a healthy rally day after day, those mark to market numbers were still very small relative to what ended up happening in early April. So you can see how a lender that may be used to 50, 60, $120,000 margin calls on a regular basis, or just paying that in cash settlement, they were suddenly looking at millions of dollars in cash that they needed to lay out. So it did cause a little bit, kind of a major shock to the system for a lot of these lenders that didn't have that kind of cash to just park with broker dealers for 30 to 90 days. On the next slide, this is just a good illustration of the volatility during that time. So not only was the market uneasy, market was moving a lot, market was rallying, but you can see that peak there and the build up to the peak. The highs and lows intraday were also becoming much larger than they typically would be in a healthy market. So it's the peak there. There were 2.5, even if we were to look at it on a more granular basis, almost a 3-point difference from intraday, from the high to the low in a given security price. So just a lot of really difficult to trade loans in that scenario, really difficult to hedge pipelines, really difficult to manage P&L during that time. But as you can see over to the right side, that volatility has gone back down to pre-coronavirus crisis levels, and I think that's somewhere where for all the Fed has done over the past couple months, one thing they've certainly done is created stability and allowed the market to come back to some semblance of normalcy, even if prices are severely elevated.
Yeah, there's if you look at bid-ask spreads, another way of measuring kind of volatility and stability, I guess, you see a similar type graph. Bid-ask spreads were just insanely wide on what should have been liquid coupons during this time frame, and so just trading in general became very expensive. On top of all the other issues we were dealing with, it was just very expensive to get in and out of trades during this time as well. But again, those have come back into normal levels as well.
Definitely. So another thing, and here's where the problem came in, right? We were actually chatting with we're talking with an economist at the FHFA last week. We're kind of nerding out on some of the macro level stuff that's related to the coronavirus and just talking about some of the data that's out there. And it was cool to see firsthand that the agencies and the regulators are really keenly interested in how we're all dealing with this, what's going on in the lender community. But it also seemed, in talking with them and talking to some others, that not everybody completely understands where the disconnect is and why there's been a major problem for lenders over the past couple of months. I think there was some folks thought it was just the margin calls. The margin calls are killing lenders. I think the piece that gets missed and that sometimes we have to explain a couple of times in a couple of different ways is that those margin calls it did happen quickly and they were extreme. But in a normal market, semi-normal market at least, loan prices would have also improved by the amount that the TBAs were improving, at least relative, for the most part during that time. But as you can see from this graph, for instance, from March 23rd, which is when the Fed doubled down and almost broke the market, there was a 5-point rally after March 23rd. But as you can see from this graph, rates to borrowers didn't drop. And in fact, by the end of March, they'd actually gone up a little bit. So we have this disconnect of major outlay of cash on the TBA side or the hedging side of the business, whereas normally you'd see rates drop a point or more, as you'll see when we get into some of the data later. So that cash should be recouped by selling loans at much higher levels, and that just this time around just did not happen. And we'll get into a little bit of the why on that here in a couple of slides, but that's, I think, the piece that a lot of folks missed is that rates have remained static even since April 1, when things very much settled down. Rates have moved maybe 1/8 of a point since then. We really should be seeing rates at a much lower level given where mortgage-backed securities are trading today. So that data, you may have seen it or may have explored it a little bit on our website. It's free to anybody, so feel free to go in there and play around with it a little bit. But it's basically based on data of loans that are locked in Optimal Blue at any given time on any given day, which in this market is obviously going to be, again, at elevated levels.
So going back through a couple of things we've been talking about and kind of thinking about what we should be thinking about as we are in this market. Jim alluded to the fact that loan prices were not moving at the same speed as TBA prices. In fact, they're often moving in the opposite direction. We're seeing loan prices deteriorate while TBA prices were increasing. And I'm sure you guys have been keeping your pulse on why that is, right? A number of factors. Overall liquidity for on the aggregator side, as well as just in the servicing market, has just dropped off the cliff as people were trying to deal with the uncertainty that we saw come out of all of this. And so, we saw co-issue buyers essentially completely back out of the market immediately, kind of all at once. One buyer backed out and everyone else followed suit all at once. Aggregators started pricing in, quite a bit of risk. They severely backed off pricing, and we'll see what that looks like. So as aggregators are backing off pricing, and you don't have an outlet for your loans, for your whole loans, or just your servicing in general, obviously the question becomes: should I sell or should I retain more? Should I retain more servicing? Certainly something that you should think about internally, and think about the risks internally about what your appetite is for servicing and how large you can grow your servicing books. But the economics, just looking at the simple economics, it makes it very difficult to argue that you shouldn't be retaining as much servicing as possible right now. Obviously, the simple there's more things going into this than the simple economics of the price of the servicing. But certainly something you should be thinking about. So we are, a few things as we look forward. We have seen a few co-issue buyers start to trickle back into the market the past week or two. hopefully others will follow suit. I think that's a really good sign for liquidity going forward. And again, if you look at servicing values in general, they have deteriorated quite a bit, but they have held up to a certain degree. So if you look at various servicing grids that are getting put out at the end of that got put out at the mid-April after in the Q2, I think we saw those values were relatively strong. So, but again, think about how that affects your business individually, and consider how you should apply those servicing values to your pipelines, to your portfolio. And if you're using that to price up front to your borrowers, think about how you want to use that to price up front to your borrowers. And we'll get into some upfront pricing strategies later as we go. We'll touch more on this retain release decision as well later in the presentation. And obviously we need to keep a close eye on not just forbearance, but default and delinquency implications. Susan touched on it quite a bit at the beginning of the call. I think we know what the CARES Act has provided, and we're seeing the effects of that, and we're seeing how many loans are going into forbearance. There's been a lot of talk about if loans, a newly originated loan, how can you sell that loan either to aggregators or directly to the agencies? And of course, there's the 5 and 7 point hits on purchases and rate term loans, and cash out loans are ineligible to be sold to the agencies if they're in forbearance. So continue to keep a close eye on those policies. I think a lot of the investors have, at this point, released their policies on those loans. Some of them will still hit you with those price hits if, it's been 15 days. If the loans, if it's 15 days past the purchase date, excuse me. So continue to keep a close eye on the guidance for those. I think, one of the things we need to keep an eye on is that we can help our sales staffs with is trying to help the borrower education. Of course, you can't guide them to not go into forbearance, but I think borrower education is super important so that they understand, what forbearance truly means. And that they are going to have to answer to this at some point when loans move out of forbearance, and what options they may have as loans move out of forbearance. We'll continue to see quite a bit of guidance surrounding that in the coming months, I would imagine. I think otherwise, if they don't change the policies as they are in place now, in terms of loans that have been in forbearance in the past 12 months not being allowed to refi, I think we're going to see some major issues in the industry. So there's got to be some support in that regard. And then, new data coming out today, yesterday and today, in terms of the numbers of defaults and delinquencies in Q1 recently, those delinquency numbers have increased dramatically. So what are going to be the implications of that on the industry? So a lot of unknowns surrounding these how we're going to deal with this data over the next 4, 6, 8, 12 months, 2 years. The default and delinquency, that's something, the discussions surrounding default and delinquency has picked up steam over the past week or so. Rumors going around about, are we going to see another adverse market fee applied by the agencies? Are they just going to increase G fees? What exactly is that going to look like? I would imagine we will see something because there's going to be quite a bit of pain at the end of this, as we do see, presumably see quite a bit of defaults over the next year or so. So, no actionable items quite yet, but you got to keep your ear to the ground to see what will happen and how it will affect your business model in particular.
Right. So obviously, in our industry right now, we're in a very fluid situation, right? And it's a microcosm of a very fluid situation going on in America and going on in the world in response to this pandemic that's changed the whole way we live our lives. And as Jeff alluded to, and as we've mentioned, and going forward in this presentation, and you're going to hear it everywhere, I think a couple themes are just general things to do, or, keep your ear to the ground, look at data, and communicate, right? Because things are going to be changing every day or even intraday as we go forward. Even though things have seemed to stabilize a little bit, we're in this kind of next normal, right? It was the old normal, then the new normal, and we're in this next normal for the foreseeable future. And I think it'll be months, it could be years that we're seeing change, change that we're not used to. So we're going to show you some pretty cool data here on the next few slides. Some stuff that is available out there. Some of it's on our website. There's other things you can get from just from watching the market if you happen to follow TBA prices. But ask questions at the end if you're curious on how you can get your hands on some of this stuff. But this is really where the rubber meets the road financially with what's going on right now. So the graph on the screen is just one way to look at the disconnect between TBA prices and loan prices, right? Why do we care about that, right? Sometimes it's not super easy to explain, especially if you work at a bank or a large organization where up the chain in terms of the folks who run the finances, they may not completely understand what's happened over the past couple of months. Basically, we care about how loan prices relate to TBA prices because we're using TBAs or MBS to hedge loans, right? To hedge locks that are in the pipeline for newly originated loans. So over time, like on the left side of this graph, over time there's just a spread between the price of a loan and the price of a TBA. And that price, if you look back 10 years, is relatively stable, like very stable. But mid-March of this year, that spread really started to break down. You can see it here on the graph as the lines get closer together in mid-March. You still have, the blue line above the orange line, meaning there's still a spread between TBA and loan price, but to the extent that spread has eroded is basically basis or price that's been lost to the dynamics of this new market. And you can see right about towards the end of March, the two lines actually cross each other. So you've got loan prices that are now significantly lower than TBA, where they usually hold a relatively wide price spread between the two, a positive spread between loan price and TBA price. So on the next slide, we basically look at the spreads themselves, right? The previous slide was kind of to illustrate the dynamic of how that normally would look. And then here's some different ways of looking at different types of spreads over time, and then comparing that to some of the volume that's been going through the market. So the three lines, the green line is cash pricing from the agency cash windows. The yellow line is conventional pricing from aggregators, and the orange line is pricing from aggregators for government loans. So this is all based on actual loans being sold into the market. So it's not just best efforts, not just mandatory. This is for every loan that gets sold out of Optimal Blue's system. We're taking a look at the moment that loan is committed to an investor, what was the spread to TBA? So as you can see on the left side, again, going back to early February, that spread, and we've normalized it to zero, essentially, to get a feel for how has that spread changed since the beginning of the crisis. So rides around zero till beginning of March, even into mid-March, and then over the course of about a week, that spread drops precipitously, right? For conventional loans, about 300 basis points is lost to basis, and then for government loans, when we hit the bottom, about 5 points. And you can see during that time, there's still, the volume is increasing, right? Borrowers are getting word that rates should be going down. In general, rates are still very low, as we saw, right? Rates got low before the crisis happened and just haven't gone much lower since then, but pipelines are still filling up. Loans that were locked in February during the healthier part of the rally are starting to be sold. And being sold into this severely depressed market for whole loans. You can see over time, though, that spread has certainly stabilized. It started to stabilize about the beginning of April. And that's about the time we and others, kind of sounded the cautious all clear, right? It is fine to be hedging loans again. We're seeing that these spreads are stabilizing, even improving in some cases. It makes sense to continue originating loans. I mean, that was a question for some originators. Should I even continue originating loans, which is at the time more of an existential question of, can I retain my originators or even float my business without originating loans? And it's proven to be, it's proven that the Fed actions, in addition to just a little bit of confidence being re-injected into the market, and these healthier spreads, frankly, that aggregators are taking, has created this next normal where you can now originate loans. If you've originated anything new lock-wise since April 1st, those loans have very healthy gains on them and are even improving, benefiting from some of these improvements in these spreads that we're seeing. Anything to add to that one, Jeff? That's a pretty influential slide, pretty big one. We do publish these numbers on our site. This is one of the things where these are numbers that everybody should be looking at every day. We certainly are. We're communicating with each other and with others in the industry and investors and customers specifically, just to get a feel for, what kind of improvement we should expect to see here. At this point, I don't think we expect any material deterioration here, especially on the average.
Yeah, I think that's right. We certainly expected in a rallying market, we certainly expect some deterioration. As servicing values deteriorate, as rates are moving down, but certainly nothing to this extreme. Even on the cash window side, we expect some deterioration, but again, it was even extreme there, but certainly nothing like we saw from the aggregators.
So yeah, this is just another way to look at the same numbers. So this is price converted to rate. So again, to hammer it home, rates should be lower today than they are, right? Rates to your borrower, and because the market has rallied 6 points since the end of February, even when February was a great month for TBAs. But we're seeing, like the orange line will tell you, we're seeing government rates about 1.5 points higher than they otherwise would be, based on what mortgage-backed securities are telling us. And the yellow line is aggregator conforming. So we should be, conventional lenders should be able to offer rates at least 1 point lower than where we are now, right? So if we're in the kind of the low to mid threes, we really should be in the low to mid twos. And then the green line is the cash window, which kind of helps temper, I think, some of the yellow line a little bit, where a lot of you and a lot of our mutual customers have the ability to sell to the cash window, and that deterioration has been far less, especially if you take out the specified pool pricing and the low balance kind of stuff. There's been a lot more stability provided there, but in general, there's still just this unprecedented gap in pricing that's created this this new dynamic.
Yeah, this one, this slide is maybe a little bit more theoretical, a little bit of a theoretical Libra. There's, other factors going into play. There's kind of a lower bound on rates in some ways. And, part of the issue is some of the lower coupons. It's getting people to truly believe those are, getting some real liquidity in the market. So say for UMBS 2s and Ginny 2 coupon. So, some of the other factors going into play, but, one of the biggest things, the biggest reasons that the primary secondary spread has widened out is this previous slide really right here. So
definitely can't stress those last couple slides enough. Like, that is what happened, and that's but it is stable to improving. And the key there is that the damage is done, right? We're obviously all need to be keeping an eye on those numbers worsening or the next wave of problems coming through, but it does feel like the market has hit that bottom, and now we're either recovering or at least maintaining stability. So it does make a lot of sense to continue hedging loans, keep loans moving through the pipeline, and keep regaining cash. And that gets us to this slide, which is the best efforts mandatory spread. So those of you who do hedge loans with TBAs have heard of this, and those of you who have not may be curious about it and may have heard about what that spread looks like. It is cited as one of the major advantages to hedging loans as opposed to delivering best efforts. And historically, that number over the past 5-7 years has been in the call it 25 to 3/8 of a point range, right? difference between a best efforts price and a mandatory price. And you can see since early March, it's really spiked. And it's a risk premium. It's not out there for free, right? It exists because hedging loans has inherent risks in it. You have to manage your own pull through, your own fallout assumptions. Obviously, this somewhat new risk of investor prices completely cratering due to the coronavirus was another risk that was out there. So investors really stepped up the premiums they were paying for mandatory versus best efforts during this time. Investors don't want to necessarily take on that risk of accepting best efforts locks and guaranteeing a price for 30, 60, 90 days, right? So they're still paying a pretty hefty premium for delivery of mandatory, right? They would rather buy that loan today from you, securitize it later this month, and be done with it, right? Be done with some of those risks. But again, that's a risk that then gets, that ends up with the lender. So there's a balance there, but the premium being paid for it right now is still very, very healthy. So about close to 100 basis points still on conventional, and call it 125 to 150 on the govies. And it's kind of related, but another dynamic that's really been drastic over the past month and a half. For those of you and the lenders out there that are able to deliver to the agencies, there's been a significant increase in basically market share for the agency direct. So that'd be cash window as well as lenders that are securitizing with Ginnie. So the orange part of the bar, that's your traditional aggregators, and the blue is agency direct. So you can see in late February, early March, that's kind of what we normally see. 70 to 80% of loans go to the aggregators, at least in our book of business at Optimal Blue, and then 20, 30% go agency, and that has almost flipped completely since then. You can see it started to drop off a little bit in mid-April, and then early in May, we started to see the agency win rates really peak again. So as of last Friday, 80% of loans are going agency direct. So even though there's this huge glut of volume coming through, and the aggregators have backed off mostly because of forbearance issues and just volatility in the market, they've also, I think, proactively backed off a little bit because they see volume coming. But I think a lot of that they're not seeing, right? If you look at just overall volume numbers, it kind of evens out to the point where the aggregators are seeing similar volume that they saw before this spike that we're seeing right now, because there's so much going directly to the agencies, whether it's through the cash windows or direct securitization. So an item that's come up kind of after the massive price drop off, there was more talk about forbearance, and the FHFA put out some direction about forbearance and how that's going to be handled just at the loan sale point, right? What loans can be sold to the agencies if they're in forbearance between when they close and when they get sold or securitized. And one thing that came out of that was some changes to guidelines, and in some cases changes to LLPAs that relate to certain loan characteristics. And some of that was going on even before with government, right? You saw low FICO government loans kind of get thrown out, or get priced out of the market, get removed from guidelines, get overlaid because there was, again, this fear of forbearance, which typically is going to affect the lower credit borrower, lower income borrower. The borrower does not have any kind of significant down payment on their house. It's just easier to risk not making payments on your loans. We did see, it was one of the reasons we saw government loans fall off quite a bit more in terms of basis earlier on, but now it's starting to get a little more specific. So a lot of you may have recognized that cash out was one of those items, right? Right when the FHFA came out and said, they offered some, some relief, right? You can sell loans to the agencies if they're currently in forbearance. There's a pretty hefty fee associated with it, as Jeff mentioned, 5 points or 7 points, depending on whether it's a purchase or a rate term refi. But cash out loans are still ineligible for sale to the agencies if they're currently in forbearance. So we saw cash out pricing suddenly either disappear, meaning some investors chose not to buy cash out loans at all, or we just saw that pricing get hit pretty hard, especially on the best efforts side, right? I think what we saw and what we hear from investors is that there was a sudden flood of loans being locked best efforts with investors that were cash out. So investors reacted by either closing the door on cash outs completely or by worsening best efforts pricing by kind of an extreme amount, right? 2, 3, 4, 5 points. So we've been looking at the market a little bit more holistically and looking at actual loan transactions. That's that orange line there on the screen. That's cash out versus the other two lines, which are purchase and rate term. So really trying to keep our eye on where are loans actually trading, and are they trading to the depths that would be, suggested by what we're seeing in best efforts pricing. And so far it hasn't happened. So in general, we'd recommend, you're probably at this point better off, especially if loans are already in your pipeline, leaving those cash out loans in your pipeline and delivering them into the market as you normally would, auction them to as many investors as you can. And again, this is if you're delivering to the aggregators. The cash window, there's been no significant changes in price for cash window, cash out. So I think for now, you're good there. But even on the aggregator side, the drop off in price for cash outs is not nearly what best efforts would suggest. So that's just one example of what kind of loan characteristics or what kind of areas should we be worried about, right? And on our previous webinar, OB webinar, we asked the group, or it was 2 weeks ago, we asked our participants, what do you think is going to be next, right? What loan attributes should we be watching out for? And non-owner occupied or investment property was one that came up frequently. So we've been watching that along with a lot of other loan characteristics, just watching actual live loan executions for that. And so far we haven't seen anything. In the investment world, you can see the blue line here. That's investment property pricing versus the orange and the gray, which are second home and primary. And really what we're trying to monitor is how have the spreads in pricing between those three occupancy types, how much has it changed since early February? Really, there's been no change. So that's healthy for now, but something we and others will continue to keep an eye on.
Yeah, it does feel like there could be another shoe to drop, or as again more data comes out around defaults and delinquencies, and as the FHFA and investors react to that news, we'll see if particular types of products and types of loans get singled out, or if some of that happens across the board. But again, just keep your ears and eyes open for that type of news so you can react to it as quickly as possible.
Definitely. I mean, for now, it's really wait and see, right? Up until this point, we definitely have customers ask, should I hedge the kitchen sink, right? Everything. And to be conservative, the answer is probably no. It's, if you've got if you're still originating some of the more risky stuff in terms of guidelines, it may be good to lock those best efforts. So low FICO government, if you're actually still playing in that realm, sub 680 Govy, if you want to be conservative, it might could make sense to lock those best efforts up front. Anyway, that's just good to keep an eye on things that change. If the agencies do come out with additional direction on cash out, or we see that pricing continue to deteriorate, probably good to keep those out of the hedge. But for now, I think it's just good to look at the facts and kind of weigh your options. Mark-to-market update. So this is some good stats on what happened in March, how have we recovered since April 1st, and what are customers experiencing on the average. So this first set of bullets here, we saw the average mark-to-market deteriorate 118 basis points in March. It's probably not a surprise to anybody. Certainly some government-heavy books that dropped more than that, and some customers who deliver direct to the agencies where it was less. But overall, if you continued adding loans to your position throughout March and kind of followed the trajectory of the average mortgage lender, the average drop-off altogether from March 1st to March 31st was about 118 basis points. And like we said earlier, like what you see in the data, right around April 1st, spreads tapered, right? Spreads hit a bottom. And at the very least, they stabilized, but in most cases, they improved throughout April. So customers and lenders have continued bringing new loans into the pipeline at higher margins as well, are continuing to originate, continuing to sell. Kind of, we've heard it called, dollar cost averaging, just keeping loans moving through the pipeline at these new levels. They saw an average increase of 93 basis points to their mark to market overall, including cash settlements, 93 basis points, which starts to get really close to being back to normal. And then in May, so far, in the first 11 days of May, we've seen an additional 35 basis points on top of that. So really seeing customers showing not just signs of recovery, but showing the results of it, right? So by the end of May, we would expect that most clients who continue to originate loans, again, at some higher margins, but also just continuing to keep the coffers full, but continuing to be able to push that volume through the pipeline, should be year to date kind of back to quote normal, right? Back to gains that are above best efforts, back to healthy gains on the margin side specifically, which we'll get into here in a minute, just because volume is so high. Again, so very encouraging numbers there. And again, continuing to watch the spreads, but for now, seeing likelihood of full recovery by the end of this month. So what's affecting that? As we've said, new locks coming in, pretty much all lenders have raised margins. So that helps out a lot, right? That slows down the volume a little bit so it can be more easily managed, and also makes up for a lot of what was lost in March. And maintaining value. So that is the spreads that we're talking about, right? The pipelines have maintained value since April 1st, and then you're adding value to it by every single loan that gets locked. So overall gains are just continuing to average up. And that basis recovery is contributing a little bit of alpha to that, right? The pipeline being equal over time, you're still going to gain additional basis points just by the market recovering a little bit and investors getting a little more aggressive by the day. And the best efforts mandatory spread has remained elevated through this whole thing. So there's still, to the extent that lenders are still, pumping volume through the pipeline, selling on a frequent basis, there's still a lot of spread to be had there that you don't see on the best effort side. And last bullet point here, just as it relates to mark to market, some of you have seen on our webinars that we've introduced a tool that can be used to the extent that a lender is very sensitive to changes in their mark to market. We've built some pretty neat tools around price prediction, right? In this market where, going back 5 years, where most loans are delivered into kind of a black box, right? They're auctioned off to investors. Investors come back with pricing without anything really being published out there to calculate a loan price yourself. We've developed some processes to predict loan prices on loans that are currently in the pipeline based on actual performance of that particular lender historically into that black box. Anything you'd add to that, Jeff?
No, it's just some cool techniques, some machine learning techniques using the historical bulk bid data to be able to predict what we think the bulk bid price would be on a given loan at a given point in time in the market. So we can use that, trying to get some of the auditing firms comfortable with that, and we think we are starting to get them comfortable with that, but use that for mark-to-market purposes, so you can get some sort of estimate of what the bulk price would be into your mark-to-market values. And again, it doesn't change the end cash flow certainly, but it does at least change the value of your open pipeline. So pretty cool things we're working on there.
Very cool. Yeah, we love to nerd out a little bit, and this is another spot where you can certainly nerd out. We have customers nerd out. We hit this analysis just the other day to add to some of our weekly webinars. We've had a lot of customers ask us, what have customers done with their margins during this whole thing, and when did it start, and is it continuing? So we just went and did a simple analysis in our competitive business intelligence application, so what you've got on the top of the screen here is orange line is a hypothetical customer. It's a fake customer. Obviously, that customer was asleep at the wheel during the crisis, but the blue line is an average of all of our customers, every customer that uses Optimal Blue in general, whether it's for pricing, hedging, or anything else. And you can drill down into your own MSAs, your own state, or your own different products, but we just looked at it overall. What have margins done since the beginning of February, or the beginning of the year in this case? And as you can see, the blue line margins kind of stayed static until late February when pipelines really started getting full. And then as the crisis really kicked in, margins grew significantly to the point where margins were up about 5/8 of a point on average, which is when you're looking at, tens of billions of dollars worth of loans, that's a decisive move, right? Over time, those numbers tend to be, wiggle within a 10 basis point move, but we're seeing a 5/8 of a point move in less than a month. So just kind of a cool stat that we decided to look at after getting certain types of questions from clients, and something that I think is valuable for anybody to look at. So that this tool is, there's tools out there like it, but I think this one just tends to have a lot more data behind it than most, just because of the amount of data that goes through our system. It's a good way to benchmark yourself against your competitors or just against the market in general, and get an idea for what your rates look like, your margins, your concessions, your product mix, things like that. So anyway, this is kind of a cool data slide we've liked sharing with people over time. This is a little bit of a marketing slide for the product, and on the bottom right, you can see how granular you can get. Probably more granular than I'd want to getting down to actual FICO and LTV level. But in any case, it's something you can do. Actually compare your lock volume to others in the industry or others in your MSAs. So our last slide is kind of wrapping this up. What's the strategy right now, and what things do we really need to continue thinking about as we go forward? In 3 categories, right? Pipeline hedging being the first one. Right now, aggressively managing your pipeline population continues to be huge, right? We were monitoring pull-through pretty closely at the beginning of this crisis, and we expected to see a little more volatility, but it seems lenders have really adapted and managed to keep their pipelines very clean, have managed not to lock a lot of loans that really have no business being in the pipeline or probably won't close. So, we saw a little bit of a dip at the end of March, and some of that was just from customers aggressively clearing out dead wood in the pipeline. But since then, pipelines have maintained a pretty good level. But I think it takes a little diligence to keep that going, right? You do run the risk if you do have some basically cancelable loans in your pipeline, whether it's due to bad VOEs or just loans that got locked at the top of the market. I think it's good to hash that down, because otherwise you can end up hedging more than you need to. And it makes sense to manage your pull-through along with your hedge advisor during that effort, just to make sure that you're keeping your model up to date, so you're not having to eyeball your position based on where you think pull-through is going. Front end wise, front end pricing has been a little bit tricky, with best efforts pricing really falling into the toilet. I think if you're delivering to the agencies, even to any significant degree, it can be good to set your pricing based on that. Otherwise, best efforts is still a fine base to use for pricing, but you may need to loosen margin in some cases, right? There's this 100+ basis point spread that you're getting, and you can likely measure that at your level, right? At your client level. Our system certainly does that, and I think others do as well. And you can take some of that gain that you're picking up between best efforts and mandatory and put it back into your margin, so that you can make deals work, right? Especially on the government side, it's been difficult to get rates to work for borrowers with certain kinds of premiums in them. Loan sale side, like we talked about earlier, cover new locks, best efforts if there's any worry about spreads or guideline issues. So right now, if you want to be conservative, government loans less than 680, be locking those best efforts. Again, cash out loans, can't predict the future. New locks coming in, to be conservative, you should lock those best efforts. And then just continue to watch the data and continue to listen to your hedge advisors and just what's going on in the market. Deliver to the agencies if you can. Obviously, we've talked a lot about that. But if you're non-agency direct, the cleaner buckets should be hedged, like we've been talking about. And just continue watching the data and continue communicating. Watch this, those spreads that we were looking at earlier, the basis spreads. Watch your mark to market for signs of improvement, and more importantly, any kind of deterioration. The daily market briefing is how we publish this type of information. There's probably other resources out there as well. And most of all, I think keep selling. Our customers who have had the most success during this whole thing have just continued originating new loans and continued selling loans, and not waiting for anything to happen, not waiting for the improvement to happen, because I think we're going to continue to see kind of a gradual recovery over time. But I don't think it makes sense to gamble and try to hold your entire pipeline for that recovery to completely materialize, right? We could be talking a number of months, certainly, and years maybe before that happens. So I think continuing to originate at the new norm and sell into the new norm is how vast majority of our customers have remained very successful.
Yeah, I think, just to reiterate, I think, we may see a gradual improvement in investor basis, but certainly there's risk out there in terms of, like we've talked about ad nauseum here, guidelines changing and other effects of this in terms of maybe an additional adverse market fee. So you want to make sure you're selling your loans and getting your loans off the books as quickly as possible, getting those loans turned with the investors. Investor term times have been pretty reasonable. Again, they haven't gotten as much volume as they would in quote a normal market. So just make sure you're selling your loans quickly and getting those loans turned and purchased as quickly as possible, so you don't have to worry about guideline changes or loans going into forbearance immediately after they've closed. So can't reiterate enough. I think keep selling is important here in this environment.
Definitely. All right. Questions, comments, anything anybody wants to share with the group or ask?
Great. Thank you. Thank you both, Jim and Jeff. Great information. Certainly invite any of you to use the questions dialog box and pose a question to our panelists. I do have one to start us off. How much have broker-dealers reined in independent mortgage banks versus banks?
Certainly, I think that the risk departments of the broker-dealers, they keep a closer eye on those with lower net worth, which tends to be the independent mortgage bankers versus the banks. There have been, I think I was pleasantly surprised at how well all different entity types handled the margin calls that came at the end of March. And those that made their margin calls really, I don't believe they're being any more heavily scrutinized as long as they've kept their net worth up and they've made good on their settlements. Honestly, there's just been, I think for new applications though, there may be some more difficulty with some of the lower net worths getting lines versus banks who have typically been a shoe-in for getting lines approved.
Next question, what are you seeing for servicing spread multiples?
Yeah, I guess we didn't talk about exact levels, right? But, on the conventional side, if you're, before the crisis, if you're looking at 4 to 5 multiples, they've certainly deteriorated to, 2.5, 3 multiples in terms of how you may value it internally. Again, co-issue buyers, they've been out of the market, so really haven't seen anything from co-issue buyers, but starting to pop their head back in the last 10 days, albeit at lower multiples again, but that 2.5 to 3 range, but at least there's some liquidity. So they've deteriorated. I guess it's all relative, right? I mean, I guess in a normal market, you'd say that is an insane deterioration, but we kind of look at that compared to aggregator pricing. It's really not too bad if you can still get those types of values instead of having to sell loans to aggregators. So, moving from 4, 4.5, 5 down to 2.5, 3. Some of the lower note rates, 3.5 range.
One question, another question we have, there's been talk of, as our economy reopens, kind of been perhaps seeing an increase of, cases of COVID-19. Do you foresee that kind of having the similar impact to P&L that it had for March for our industry?
Yeah,
that's a good question. Go ahead, Jim.
I think it's a very good question. I think right now, if spreads remain where they are, I think it probably does not have anywhere near the type of deterioration we saw in March, because we're still at very depressed levels versus where MBS or trading. If we saw a full recovery back to pre-COVID-19 spreads for aggregator pricing, I definitely think there would be a deterioration at that point, depending on what the projections were for this new wave, right? Whether that would double or triple forbearance type of issues, or really dig deeper into business closures and extend this period of time that we're all kind of anticipating being locked in at home.
Mm-hmm. Mm-hmm. Any thoughts on MSR values?
Just in terms of if there's like a W recovery, like related to the last question.
That was, well, it's another question, so I don't know whether that's kind of
Gotcha.
already been. We've
Yeah, I
already.
mean,
Yeah, so much of that is going to be around. I think people are still wrapping their hands around exactly how to model in the specifics of forbearance and what the levels of delinquencies and defaults will be going forward. So I think people have tried to do that, and that's why you've seen that deterioration of servicing multiples down to the 2.5, 3 level for internal servicing valuations. But the data going forward and what's going to happen as loans move out of forbearance, the policies that are enacted is going to have a huge effect over the next few months on how we determine the value of MSRs going forward. So there's still a few too many unknowns, and we're just waiting to see the true economic impact to the industry to the economy, and see how those delinquencies and defaults come into play. So
Right. Well, I think that brings us to the top of the hour. And again, Jim, Jeff, thank you so much for a great set of information for today's webinar. Just to note that the recorded version will be available on our YouTube channel, as well as our members only site. And that concludes today's webinar. Thank you all for joining us, and I hope that you have a great rest of your day.
thanks, everybody.
Thanks so much.